Welcome back to the deep dive. Today, we're digging into something really crucial, especially in choppy markets like we sometimes see. It's all about disciplined exits.
Yeah, it's a topic that, it doesn't get the glamour of finding the next big winner, but honestly, it's probably more important for survival.
Right.
We looked at what some legendary traders had to say, folks who really weathered storms, and the focus wasn't just on winning, it was about, well, not losing big.
Not letting small mistakes become total account blow-ups.
Exactly. It's about staying in the game.
Okay, so let's unpack the big takeaway.
Yeah.
Sounds almost too simple, but basically everyone we looked at said, know exactly where you're getting out before you even put the trade on.
Mm-hmm. And then sticking to it. That's the discipline part.
That sounds straightforward, but sticking to it. That's the hard part, right? Why is it so fundamental?
Well, fundamentally, it shields your capital. It's your safety net.
Yeah.
It means one bad idea or one unexpected market move doesn't take you out completely.
So you're always liquid, ready for the next setup.
Precisely. Instead of being stuck, hoping and praying on a losing position while other opportunities just fly by, it cuts out that emotional hope factor.
Okay, so let's get into the specifics from these legends. Jesse Livermore, for example, he had this phrase, hit the bid.
Yeah, basically means sell immediately. Like the second the trade went against his thesis, he wouldn't wait. He was out. Liquidity was key for him.
No hesitation. And then you have someone like Nicholas Darvis with his box theory. A bit different.
A bit different in method, but the principle, exactly the same. He'd define a price range, a box. If the price broke below that box,
He was out instantly.
instantly, no questions asked. What's great there is it teaches you to set that exit based on the chart structure, the price action itself, not emotion, not a gut feeling.
It's objective, which reminds me of William O'Neill and his famous 7-8% stop-loss rule. That feels pretty concrete.
It is concrete. And it was designed specifically to fight what you could call rationalization creep.
Huh, yeah, it'll come back, just a little lower.
Exactly that. That voice. O'Neill's rule was a hard stop, a fixed percentage guardrail to prevent that kind of thinking from destroying your capital.
It's fascinating how different styles all point to the same core idea. You mentioned Paul Tudor Jones, too.
Oh yeah, PTJ was, by all accounts, obsessed with risk on every single trade. Not just the potential reward, how much could he lose?
Right.
He apparently never bet more than a tiny fraction, a sliver they called it, of his equity on any one idea, which really drives home the point. Tight exit plus correct position size.
Equals survival.
That's the formula. And then you have Ed Seykota, who was famously blunt about it.
What did he say?
He said, the elements of good trading are 1, cutting losses. And then he skipped number 2 and said 0.3 cutting losses.
Okay, message received. It's not just part of the strategy. It is the strategy, almost.
It's absolutely central. It's the difference between lasting and, well, not lasting.
So for listeners, how do you actually put this into practice? It's more than just picking a number, clearly.
Right. It starts when you're even considering the trade. Before you click buy, ask yourself, what has to happen in the market for this idea to be proven wrong? What's the invalidation point?
Find that point on the chart.
Exactly. Look at the market structure. Is there a recent swing low? The bottom of a consolidation, like Darvis's box. Maybe use something like an ATR multiple, which adjusts for volatility. Place your stop based on that.
Not just like a dollar amount you feel comfortable losing, or a round number.
Definitely not. Make it objective. Then, crucially, size your position based on that stop level.
Ah, so the stop distance determines the shares, not the other way around.
Precisely. You calculate your position size so that if your stop is hit, the actual dollar amount you lose is small, like say 1% or maybe 2% of your total trading capital.
So no single trade can cripple you.
That's the goal. And the final piece is, well, discipline. Maybe use technology. Set an actual stop-loss order or at least a price alert.
And then walk away. Don't keep staring at it.
Try to. Staring invites tinkering, second-guessing. Let the plan work. And, importantly, log your trades. Note why you exited. If you followed the plan, even on a loss, that's a win for your process.
And if you chickened out or moved the stop, analyze why. What was the emotion?
Yeah, learn from it. Build that mental toughness.
So wrapping this up, this deep dive really underscores that disciplined exits aren't just about limiting losses. They're fundamental for staying in the game long enough to actually win. It's about resilience.
Absolutely. And maybe a final thought for you to consider, if these absolute titans of trading, Livermore, Darvis, O'Neill, Jones, Seykota, if they all relied so heavily on predefined, rigidly enforced exits, What does that truly tell us about that very human urge to just hope for a losing trade to turn around? And how could recognizing that tendency maybe reshape your own approach to managing risk?